There's a phrase on Wall Street you almost never hear in public. Not on TV, not in press conferences, and it definitely doesn't trend on social media. The phrase is "sell America." It doesn't mean dumping one stock or getting out of one sector. It's deeper and far more serious. It means global capital is starting to reduce its exposure to U.S. stocks, U.S. bonds, and the U.S. dollar, all at the same time. Not because of a single crisis, but because the risk of holding so much in one place no longer makes sense. When this phrase starts circulating quietly inside major institutions, it signals a fundamental shift in how the world values America itself. Right now, America isn't being bought, it's being sold. Quietly, calmly, without any panic or screaming headlines. This is how real financial shifts begin. Not with a loud crash, but with quiet exits. It's like capital slipping out the back door while everyone is still busy watching the front. By the time the alarms finally go off, the big decisions have already been made. What we're witnessing isn't a market that's failing loudly. It's a system being downsized silently. And that distinction is more important than most people realize. On the surface, everything looks fine. The stock market is near its highs. The headlines talk about resilience. The dollar is called strong. The economy is described as flexible and adaptive. To the average person, this all seems to confirm that the system is healthy. But here's the secret. Surface strength is the perfect place to hide what's really going on. When markets stop reacting to good news, when rallies feel thin and artificial, it usually means something else is happening underneath. Big money doesn't announce its departure. It disguises it as stability. They don't crash the market on their way out. They drain it slowly, letting someone else hold the bag. This is where the difference between smart money and loud money becomes critical. Retail investors, the everyday folks, they see price. They see green on the screen and think every dip is a buying opportunity. But institutions? They see something else. They see capital flows. They see the depth of liquidity. They see who is actually buying and, more importantly, who is quietly stepping away. When institutions reallocate their massive portfolios, they don't do it based on emotion or headlines. They do it systematically. They shorten the duration of their bonds. They hedge their currency exposure. They reduce their concentration in one country. And they do it slowly enough that prices don't immediately collapse. That's why the public so often feels blindsided later. By the time the price finally drops, the smart money's new positions are already locked in. One of the earliest warning signs appears in the bond market. You start to see foreign demand for U.S. Treasuries soften. Government bond auctions that used to be effortless suddenly feel a bit strained. Yields start to rise even when the Federal Reserve isn't officially raising rates. These are not random quirks. Historically, these signals appear when trust in the risk-free story starts to weaken. The bond market doesn't panic easily. It moves when fundamental trust shifts. This is why bonds matter more than stocks. Stocks are emotional. They reflect optimism and speculation. Bonds are structural. They reflect trust in the entire system. A shaky stock market can recover quickly. A stressed bond market points to a much deeper fracture in the foundation. Then you have the dollar paradox. The dollar can look incredibly strong even as confidence is eroding underneath. In fact, that's often what happens first. During times of uncertainty, capital rushes into the dollar, not because faith is increasing, but because all the other options feel even riskier for a moment. This creates an illusion of strength. But think of the dollar as a pressure valve. It doesn't get rid of the pressure, it just contains it. When the underlying confidence finally breaks, the reversal can be incredibly fast and violent. So, a strong dollar just before a systemic crisis isn't a sign of protection. It's a sign of compression. This "sell America" environment unfolds in phases. Phase 1 is the silent rotation. This is what's happening now. Global investors gradually reduce their exposure without triggering any headlines. Their portfolios shift toward shorter-term assets, commodities, and other regions of the world. They increase their currency hedging. None of this requires the market to fall. In fact, the market can remain deceptively calm during this phase. That calm isn't an accident. It's a feature. It allows the big players to exit without drawing attention. Phase 2 is the liquidity tightening. This is where the effects start to become noticeable. The market starts to feel jumpy and fragile. Small news events cause oversized reactions. Volatility spikes appear out of nowhere. This phase is confusing because there's no clear story. It just feels random. But it's not. It's what happens when the big money that provides liquidity has stepped back. Phase 3 is the confidence fracture. This is the most dangerous phase. It doesn't begin with a headline. It begins with behavior. Currency hedging accelerates. You start to hear quiet talk in policy circles about capital controls. Official statements start using carefully softened emergency language to avoid causing alarm. At this stage, the debate is no longer about growth. It's about containment. Once confidence fractures, it's incredibly hard to restore. You can't just print credibility. Throughout this entire process, the illusion of control is maintained. Officials reassure the public. Narratives focus on resilience. This isn't necessarily a lie. It's psychological management. The system cannot afford to have a panic, so it manages perception. But managing perception doesn't stop capital from moving. It only delays public awareness of that movement. What makes this moment different from past crises like 2008 is that it isn't centered on one single failure, like the housing market. It's centered on something much broader: confidence. Global capital is questioning the risk of being too concentrated in one country. The world has changed. Debt levels are at historic highs. Geopolitical alliances are fractured. In this new environment, Sell America isn't an attack. It's a logical rebalancing. For everyday Americans, this isn't some abstract theory. It arrives as real-world pressure. It's borrowing costs that stay high. It's retirement accounts that feel volatile for no clear reason. It's a dollar that buys less and less. It's a job market that feels insecure even when the official numbers look good. These are the real-life effects of capital moving away. They start subtle, but then they compound. At the same time, the rest of the world is quietly adjusting. Countries are settling trade deals in their own currencies. Central banks are diversifying their reserves away from the dollar. New payment systems are being built outside the traditional channels. This isn't being done out of hostility. It's being done out of pragmatism. When the world feels less predictable, diversification isn't a choice. It's a survival strategy. And at the center of it all, the Federal Reserve is trapped. It's caught between defending the dollar, stabilizing markets, and protecting jobs. Every tool it uses now damages something else. If it tightens policy, it breaks the market. If it eases, it risks hyperinflation. If it does nothing, it loses all credibility. The Fed is no longer choosing the best outcome. It's choosing which pain to feel first. The most dangerous moment in any systemic shift is when the public finally notices, but it's too late. By the time the headlines admit there's a problem, the exits are already crowded and the choices are limited. That's why you have to watch what they do, not what they say. You can listen to policymakers talk about confidence, or you can watch where capital actually flows. Capital doesn't lie to protect morale. It moves to protect its value. Sell America is not a prediction of a crash tomorrow. It is the recognition of a process that is already underway. It is a posture, a behavior pattern you can see in capital flows and hedging strategies. It thrives in the calm, and that's what makes it so dangerous. When this phrase finally enters the mainstream conversation, it will feel sudden, but it won't be new. It will just be newly noticed. And by then, the quiet exits will already be complete. Thank you for watching. Remember to subscribe for more insights that look beyond the headlines.